Good morning, my dear students. Good morning, one and all. Welcome to the first session of the course. The topic name is Introduction to Behavioral Finance. We need to talk in the introduction lecture. That's demystifying behavioral finance. That's bridging the gap. It's between emotion and economics. We can say some example. In the ever-evolving landscape of finance, one theory has emerged as a game changer. That is behavioral finance. While traditional finance, it relies heavily on a rational decision making and efficient markets. So behavioral finance, it introduces the human element, acknowledging that investors are not always rational and markets are not always efficient. So that's why in this part of the lecture and the slide, we will delve into the fundamentals of behavioral finance. That's contrasting it with financial, that is traditional finance, and exploring its implications for investors. The first point, we need to talk about the concept of traditional finance versus behavioral finance. What are the class of perspectives we have to talk here? Traditional finance, it's rooted in the efficient market hypothesis. The short code is EMH, and modern portfolio theory, MPT. It assumes that investors are rational beings who make decisions based on all available information. So according to this theory, markets quickly incorporate all relevant information. It's leading to prices that accurately reflect the true value of assets. In essence, we can say traditional finance actually suggests that investors act in their best interest, seeking to maximize returns while minimizing risk. However, behavioral finance that challenges this notion by introducing psychological factors into the equation. It recognizes that investors are susceptible to cognitive biases, emotions, and irrational behavior, which can lead to deviations from rational decision making. So instead of assuming a perfect rationality, behavioral finance, it seeks to understand how individuals actually make a financial decisions in the real world. Understand? So next we need to talk about important point of unraveling the behavioral finance paradigm. We need to talk up to the importance of four levels. At the core of a behavioral finance, it's a several key concepts we need to concentrate that shed light on why investors often behave irrationally. Starting from the loss aversion, investors tend to feel the pain of losses more intensely than the pleasure of gains. As a result, they may make a suboptimal decisions such as holding on to losing investments for too long or selling winners too soon. Second will be an overconfidence. So many investors, they exhibit overconfidence in their abilities, and they believing they can outperform the market or accurately predict the future trends. This overestimation of a scale, that process can lead to excessive trading and a poor portfolio management. The third is heading behavior. So humans are social creators, and this tendency extends to the financial markets now. Investors, they often follow the crowd, and even when it may not be rational to do so, this herd mentality, that process can amplify the market bubbles and classes and crashes too. Okay, the fourth is anchoring. So people have a tendency to rely too heavily on the first piece of information they receive when marketing decisions now. So in finance, we can say this can manifest in anchoring on past prices or earning forecast. It's leading to distorted perception of a value. We have to focus more. So by understanding these biases and heuristics, behavioral finance, it seeks to provide a more realistic framework for analyzing a financial markets and investor behavior. The next concept, we need to talk about the implications of our investors. For investors, embracing the principles of a behavioral finance, that can lead to several practical insights, starting from the diversification. Recognizing the limitation of individual decision making, investors can mitigate risk by diversifying their portfolios across different asset classes and investment strategies. Second is a long-term perspectives. By avoiding knee-jerk reactions to short-term market fluctuations, investors, they can focus on their long-term financial goals and resist the temptation to time the market. The third is a behavioral coaching. So financial advisors, they can play a crucial role in helping clients navigate their behavioral biases and stay disciplined during times of a market volatility. So in a short conclusion, we can say behavioral finance that offers a fresh perspective on the intersection of psychology and economics. It's challenging the assumption of traditional finance and providing valuable insights for investors too. By acknowledging the role of emotions and irrationality in financial decision making, individuals can make a more informed choices and achieve a greater financial well-being. So stay tuned for our next up to the lecture level where we will explore some of the practical insights for applying behavioral finance and that is some of the principles to your investment approach. Okay, the next is we need to talk about exploring the evolution of a behavioral finance. What are the tracing historical context and milestones we need to talk now? Behavioral finance is a captivating field that delves into the psychological factors that influencing financial decisions, as I told. Unlike a traditional finance theories that assume a rationality, behavioral finance that acknowledges the role of human emotions, biases, and cognitive errors in shaping investment behaviors. To truly understand the depth and significance of behavioral finance today, it's very essential to trace its evolution, exploring the historical context and significant milestones that have shaped this fascinating discipline. So the first is the birth of a behavioral finance we can talk. Actually, the roots of behavioral finance, it can be traced back to the work of economists and psychologists who challenged the traditional finance paradigm. In the 1970s, pioneers like Amos Tversky and Daniel Kahneman, they began to explore how cognitive biases and heuristics affect the decision-making level, and their groundbreaking research that laid the foundation for a new approach to understanding of financial markets now. Second is the rise of a prospect theory. And this is one of the pivotal moments in the evolution of behavioral finance. It came with the development of a prospect theory by Kahneman and Tversky in the year of 1979. So, prospect theory that revolutionized our understanding of risk and decision making by proposing that individuals do not always make choices, it's based on expected utility theory. Instead, we can say they are influenced by the potential gains and losses. It's related to a reference point. It's leading to behavior such as like a loss aversion and framing effects now. The third is the behavioral biases and heuristics. As behavioral finance gained attraction, we can say researchers they identify a myriad of biases and heuristics that affect investor behavior. From overconfidence and anchoring to heading and confirmation bias, these cognitive errors can lead to suboptimal investment decisions. So, understanding these biases is very crucial for investors and financial professionals alike, as it can help mitigate their impact and improve our decision making processes. So, next will be on, we need to talk about the market anomalies and investor irrationality. The study of behavioral finance, it has also unearthed various market anomalies that cannot be explained by traditional finance theories. And these anomalies, such as the momentum effect, the January effect, and the value premium, this is a process. It challenges the efficient market hypothesis and highlight the role of investor irrationality in shaping asset prices. Another point that is a practical applications and behavioral investing. In recent years, we can say behavioral finance that has gained a prominence in the world of investment management. Behavioral investing strategies it seek to exploit a market inefficiencies that are driven by irrational investor behavior. By incorporating insights from a behavioral finance, fund managers they aim to generate alpha and outperform the market over the long run. So, what are the challenges and the future directions? While behavioral finance has made a significant strides, so challenges it remain in applying its principles to real-world financial decision making. The field continues to evolve, we can say, with the researchers they exploring a new avenues such as like neurofinance and behavioral economics, everything. So, as technology advances and the data analytics capabilities grow, the integration of a behavioral insights into the financial practices is expected to deepen. That's paving the way for a more informed and rational decision-making level. So, in a conclusion, we can say the evolution of a behavioral finance from its inception to its current state that reflects a paradigm shift in our understanding of financial markets and investor behavior. By acknowledging the role of a psychology in shaping economic decisions, behavioral finance it offers valuable insights that can help investors navigate an increasingly complex and uncertain financial landscape. So, as we continue to explore the intricacies of a human behavior and its impact on our financial markets, the journey of a behavioral finance is far from over. It's promising new discovered and opportunities for innovation in the years to come. Understand? Okay, the next slide we need to talk about the concept of understanding the psychological dimension of a financial decision making. We need to talk up to the importance of a four levels. In the realm of a finance, numbers, charts, and algorithms that often take a center stage. However, behind every financial transaction, It lies a complex interplay of human emotions, biases, and cognitive processes too. This is where the field of behavioral finance come into play, that's shedding light on the psychological dimensions that influence our financial decisions here. The first point we need to talk about the rationality myth. So traditional economic theory, it assumes that individuals are rational actors who make a decision solely it's based on maximizing their utility. However, behavioral finance challenges this assumption. It's recognizing that a human behavior is far from a perfectly rational. Instead, we can say it explores how cognitive biases and emotional factors it often lead to irrational financial choices. Second point, that is unpacking the psychology. At the heart of a behavioral finance is the understanding that the human psychology to plays a pivotal role in shaping financial decision making. So various psychological factors come into play. As I told, according to the loss aversion, the fear of losing money often leads individuals to make irrational decisions, such as holding on to losing investments for too long or selling a winning investments prematurely. According to the overconfidence, people tend to overestimate their knowledge and abilities. It's leading them to take excessive risk or trade too frequently, but the resulting in suboptimal investment outcomes here. According to the anchoring, so individuals they often rely too heavily on initial information or reference points when making decisions, which can lead to misjudgments of a value and investment errors. Finally, being a heading behavior, as I told, the tendency to follow the crowd process, it can result in market bubbles and crashes as investors react to others' actions rather than independent analysis. Okay, the third point we need to talk about the emotions in action. We need to talk. This is also a very important level. Emotion, it also play a significant role in financial decision making. Like a fear, greed, excitement, and regret. This all the process can cloud judgment and lead to impulsive or illogical choices. For example, we can say the euphoria of a bull market may lead investors to take an excessive risk, while the panic of a bear market it may drive them to sell low out of a fear. This is a called emotions in actions mode. The final will be navigating the psychological landscape. So understanding the psychological underpinnings of a financial decision making, that's very crucial for investors and financial professionals alike. By recognizing and mitigating cognitive biases, individuals they can make a more informed and rational choices. Techniques such as setting a clear investment goals, maintaining a diversified portfolio, and employing systematic investment strategies. These all the process can help counteract the influence of emotional biases. So, what of the conclusion mode we need to concentrate? In a nutshell, we can say the world of a finance numbers tell only part of the story. The role of psychology in financial decision that making cannot be overstated here. By delving into the realm of a behavioral finance, we gain valuable insights into the complex interplay of human emotions, biases, and cognitive processes that shape our financial choices. So, armed with this understanding, we can strive to make a more rational and informed decisions, ultimately achieving our financial goals with a greater confidence and success. Okay, my dear students, I hope you have enjoyed the introduction part of the topic of Introduction to Behavioral Finance. Thank you once again, and thank you all, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the second session of the course. The topic name is Behavioral Biases. We have to talk in the specific lecture part. So, understanding behavioral biases, that's exploring the quirks of human decision making. We need to talk now. In the world of finance, we can say rational decision making is often assumed, but in reality, human behavior that can be far from rational. Behavioral finances, it delves into the psychological factors that influence financial decisions, shedding light on the biases and heuristics that often lead investors astray. So one of the key areas of study within behavioral finance is behavioral biases, which are systematic errors in judgment that arise from cognitive shortcuts and emotional factors. So in this part of the lecture, we will provide an overview of behavioral biases, that's defining them and exploring some common types we need to talk now. The first point, that is overview of behavioral biases. Behavioral biases are cognitive biases that affect individuals' decision-making processes. It's leading them to deviate from rationality and make a suboptimal choices. And these biases are rooted in various psychological factors, including emotions, cognitive limitations, and social influences. They can impact investors, consumers, and even professionals in the financial industry. It's influencing everything from investment decisions to market behavior. So, what are the types of behavioral biases we need to talk? Starting from the confirmation bias is the first level. According to the definition and impact, we need to talk everything. Okay, so what are the definition? Confirmation bias, it refers to the tendency of individuals to seek out information that confirms their pre-existing beliefs or hypotheses while ignoring or dismissing contradictory evidence. According to the impact, we can say in investment decision making, confirmation bias that can lead investors to selectively interpret information in a way that supports their initial opinions. It's potentially leading to overconfidence and overlooking risk, we can say now. Understand? So the second point, we need to talk about the loss aversion. What are the definition? Loss aversion is the tendency for individuals to feel the pain of losses more acutely than the pleasure of equivalent gains. In other words, we can say people prefer to avoid losses rather than acquire equivalent gains. And according to the impact, we can say loss aversion, it can lead investors to hold on to losing investments for longer than they should in the hopes of avoiding the realization of a loss. And actually, this behavior can result in missed opportunities and portfolio underperformance. The third will be an anchoring bias. So it's a definition, anchoring bias, it occurs when individuals, they too heavily on initial information. That is the anchor when making a subsequent decisions, even if that information is irrelevant or misleading. According to the impact, we can say in decision making, that is a financial decision making, anchoring bias that can lead investors to place undue importance on arbitrary reference points such as like purchase prices or past performance, which may not accurately reflect the current value or prospects of an investment. The final will be an overconfidence bias. So overconfidence bias, it refers to the tendency of individuals to overestimate their own abilities, knowledge, or the accuracy of their predictions. In impact, we can say overconfidence, it can lead investors to take excessive risk, trade too frequently, or fail to adequately diversify their portfolios. Ultimately, they're exposing them to unnecessary losses now. So, in a nutshell, we can say behavioral biases are pervasive in financial decision making, affecting investors of all types and contributing to market inefficiencies. By understanding these biases and their impacts, investors, they can strive to mitigate their effects and make a more informed and rational decision there. However, overcoming behavioral biases, it requires a self-awareness, discipline, and perhaps even the assistance of financial professionals who can provide unbiased guidance now. So, in the complex world of finance, we can say acknowledging the quirks of human psychology, it's very essential for achieving a long-term investment success, my dear students. Understand? The next part, we need to talk about the understanding behavioral finances. So, exploring cognitive and emotional biases, we need to talk now. In the world of finance, we can say the rational model of a decision making, it assumes that individuals make choices. It's based on a thorough analysis of available information, weighing risk and rewards to maximize utility. However, we can say in reality, human behavior is often influenced by various psychological factors that can lead to irrational decision making. So, behavioral finance, it seeks to understand these deviations from rationality and their impact on the financial markets. In this part of the lecture and slide, we delve into the two fundamental aspects of behavioral finance, that is cognitive biases and emotional biases. The first, we need to talk about the cognitive biases, how mental shortcuts influence the decision making level. Cognitive biases are systematic patterns of deviation from rationality. It's resulting from the way our brains process information, and these biases often lead to errors in judgment and decision making, as I told in an introduction lecture. And one of the most well-known cognitive biases is the anchoring bias, as I have explained on a earlier slide, where individuals rely too heavily on the first piece of information they receive and when making decisions. Because another common cognitive bias is the confirmation bias, where individuals seek out information that confirms their existing beliefs or hypotheses while ignoring a contradictory evidence there. So this bias can lead investors to overlook warning signs or dismiss alternative viewpoints, potentially exposing them to unnecessary risk, we can say now. Furthermore, the availability heuristic is a cognitive shortcut whereby people make judgments about the probability of events. It's based on how easily examples come to mind. For instance, investors may overestimate the likelihood of rare but highly publicized events such as like a market crashes, leading to excessive fear and the selling process. So recognizing cognitive biases is a very crucial for investors as it allows them to make a more informed decisions. By being aware of these biases, investors they can take a steps to mitigate their impact, such as like seeking diverse sources of information, challenging assumptions, and maintaining a disciplined investment strategy. Understand? The next level we need to talk about the emotional biases, the role of a feeling in investment choices. We have to talk some other levels. Then we'll go for a conclusion mode of the specified lecture mode. Emotions it play a significant role in shaping our financial decisions. It's often leading to biases that can impact judgment and result in suboptimal outcomes. One prominent emotional bias is loss aversion, as I told, where individuals feel the pain of losses more acutely than the pleasure of gains. This bias can lead investors to hold on to losing investments for too long in the hope of breaking even when it may be more prudent to cut losses and reallocate the capital elsewhere. Similarly, fear and greed and two powerful emotions, it can drive investors to make impulsive decisions and fear of missing out. That is FOMO. It can cause investors to chase a hot trends of speculative assets without a proper due diligence, while greed can lead to excessive risk taking in pursuit of a higher returns, my dear students. Moreover, head behavior, as I told, it's driven by the fear of being left behind of the desire to follow the crowd. This process can amplify the market volatility and lead to bubbles and crashes. That's why the investors may connect to herd behavior and abandoning their own analysis in favor of following the actions of others, even if those actions are irrational. So, in a counteract emotional biases, investors they can adopt strategies such as like maintaining a long-term perspectives, diversifying their portfolios, and adhering to the determined investment plan. Everything, emphasizing rational analysis over emotional reactions. This all the process can help investors navigate turbulent market conditions and achieve their financial goals. So, in a conclusion, we can say behavioral finance it provides valuable insights into the psychological factors that influence financial decision making. By understanding and addressing cognitive and emotional biases, investors they can improve their ability to make a sound judgments and achieve a long-term success in the dynamic world of finance. Okay, my dear students, I hope you have enjoyed the second session of the topic of behavioral biases we have discussed in this specific mode. Thank you once again, and thank you, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the third session of the course. The topic name is Decision Heuristics. We need to talk in the specific lecture module. So, navigating the mind, an introduction to decision heuristics in behavioral finance. In the vast landscape of a financial decision making, understanding the human psyche is just as crucial as grasping market trends and economic indicators. So, just into the realm of behavioral finance, a field that delves into the cognitive biases and the psychological points that's influencing our financial choices. At the heart of this discipline, it lies the decision heuristics. It's mental shortcuts or rules of thumb that our brains use to simplify complex decisions. In this part of the slide, we embark on a journey to unravel the mysteries of decision heuristics, that's exploring their definition, framework, and implications in the world of finance. The first, we have to understand the concept that's understanding a decision heuristics. Decision heuristics, it's often referred to simply as heuristics or cognitive shortcuts that help individuals make a quick and efficient decisions in complex situations. And they are a mental process that enable us to navigate through uncertainty, information overload, and time constraints. Rather than exhaustively analyzing every detail of a decision, heuristics it allows to rely on a simplified strategies that's based on a past experiences, instincts, or social influences. So what are the framework of decision heuristics we need to talk, starting from the availability heuristic. The availability heuristic, it operates on the principle that people tend to overestimate the importance of information readily available to them. For instance, investors may place undue emphasis on recent market events or sensational news stories. It's leading to irrational investment decisions there. Second point, that is representativeness heuristic. The representativeness heuristic, it involves categorizing objects or events that's based on how closely they resemble a prototype or stereotype. In finance, investors they may access the potential of a stock. It's based on its resemblance to successful companies. It's overlooking fundamental analysis, we can say here. The third point, anchoring and adjustment heuristics. Anchoring, it occurs when individuals rely too heavily on initial information, as I told on a yearly lecture, when making subsequent judgments or decisions. So this is very important bias, and it can lead investors to fixate on arbitrary reference points, such as like past stock prices or analyst forecast, that all the process it influencing their valuation of assets. The fourth is the confirmation bias. So confirmation bias, it entails seeking out information that confirms pre-existing beliefs or hypotheses while disregarding contradictory evidence. In financial decision making, investors they may selectively interpret data to support their investment thesis. It's leading to overconfidence and a poor portfolio managed level. Finally, we've been a hedging behavior. So hedging behavior, it refers to the tendency of individuals to follow the crowd or mimic the actions of others, even if it contradicts their own judgment. And this, this phenomenon can exacerbate market bubbles and crashes as investors connect to groupthink and collective irrationality. So what are the implications in finance? Actually, understanding decision heuristics is paramount for investors, financial professionals, and policymakers alike. By recognizing the biases it's embedded in human cognition, stakeholders they can devise strategies to mitigate their impact on investment decisions, market dynamics, and regulatory frameworks. Techniques such as like a diversification, contrarian investing, and behavioral coaching, these all the process can help investors navigate the turbulent waters of a financial markets while safeguarding against irrational behavior. So in a conclusion, we can say decision heuristics it is serve as both a blessing and a curse in the realm of a behavioral finance. While they offer efficiency and adaptability in decision making, they also expose individuals to cognitive biases and irrational behavior. By unraveling the intricacies of decision heuristics, they can foster a more informed and resilient approach to financial decision making that's anchored in empirical evidence and behavioral insights. So the next slide, a very important part, that is navigating behavioral finance, that's understanding heuristics in a financial decision making level. And the realm of finance, understanding human behavior is just as crucial as comprehending market trends. That's why the behavioral finance it delves into the psychological factors that influence our financial decisions. It's often revealing patterns that deviate from traditional economic theories. So one such phenomenon is the prevalence of heuristics, like mental shortcuts or rules of thumb that individuals rely on when making financial choices. This part of the slide we will explore some common heuristics in financial decision making and evaluate their impact on investment strategies. The first is common heuristics in financial decision making. Heuristics it serve as a cognitive shortcuts that help individuals make a quick decisions under uncertainty. However, these shortcuts can sometimes lead to biases and irrational behavior. Here are some prevalent heuristics that's observed in financial decision making, starting from the anchoring. As I told, the heuristics involves relying too heavily on the first piece of information encountered when making decisions. And for instance, investors they may anchor their expectations for a stock prices. It's based on a recent highs or lows. It's leading to suboptimal decisions there. Second is availability heuristics. People tend to overestimate the likelihood of events that are easily recalled from memory. In essence and finance, this could lead investors to overweight recent market trends or sensationalized news stories when making investment decisions rather than considering a broader range of information. What are the representativeness heuristic? As I told, this heuristics it involves categorizing objects or events. It's based on how closely they resemble a prototype. In investing, individuals may assess stocks based on their resemblance to successful companies without thoroughly analyzing their fundamentals. It's leading to misjudgments. Understand? Final is confirmation bias. Investors may seek out information that confirms their existing beliefs or expectations while ignoring contradictory evidence. And this bias can prevent individuals from critically evaluating investment decisions. This is all the process and it can lead to overconfidence level, we can say now. Second is evaluating the impact of heuristics on investment strategies. So understanding the influence of heuristics on investment strategies is very essential for developing effectiveness approaches to wealth management. Here are some ways heuristics can impact investment decisions. The first is overemphasize on recent performance. Investors often exhibit a recency bias. It's giving a more weight to recent market performance when making investment decisions. This can lead to buying a high and selling low, and as investors, they chase a past winners or panic sell during a downturns. Second is a herding behavior. So the tendency to follow the crowd or herd behavior. This process can lead to market bubbles and crashes, as I told. That's why the investors may buy or sell assets simply because others are doing so rather than conducting independent analysis. The third is overconfidence. So heuristics such as anchoring and representativeness, they can contribute to overconfidence in investment decisions. So investors, they may believe they have a unique insights or abilities. It's leading them to take on excessive risk or fail to adequately diversify their portfolios. And finally is the loss aversion. As I told on introduction part, investors, they often exhibit a preference for avoiding losses over achieving equivalent gains, a phenomenon known as loss aversion. This bias can lead to suboptimal decision making, such as holding on to losing investments for too long in the hope of recalculating losses. So, in a conclusion, we can say heuristics play a significant role in shaping financial decision making, influencing everything from individual investment choices to market-wide trends. By understanding a common heuristics and their impact on investment strategies, investors, they can become more aware of their own biases and develop strategies to mitigate their efforts. It's incorporating principles from a behavioral finance into investment practices. This other process can lead to more informed decision making and ultimately improve our long-term financial outcomes we can create. Okay, my dear students, I hope you have enjoyed the third session of the topic of decision heuristics we have discussed in this specific lecture mode. Thank you once again, and thank you all, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the fourth session of the course. The topic name is prospect theory. We need to talk in the specific lecture part. So navigating the mind, that's understanding a prospect theory and behavioral finance. We have to discuss in the specific lecture module. In the vast version of a financial decision making, traditional economic theories, it often assume a rational behavior. However, the realities are far more complex, as human emotions and cognitive biases it play a significant role in shaping our financial choices. So we need to enter a prospect theory, a cornerstone of a behavioral finance that revolutionizes our understanding of how individuals make decisions under uncertainty. As part of the lecture, we delve into the concepts and foundation of a prospect theory. It's unraveling its implications for investors and financial professionals alike. The first concept we need to talk about is understanding a prospect theory. Prospect theory that's developed by psychologists, Daniel Kahneman and Amos Tversky in the year of 1979, that challenges the conventional wisdom of economic rationality by proposing that individuals do not always make decisions based on expected utility theory. Instead, we can say they evaluate the potential gains and losses that's related to a reference point. It's often the status quo or a certain baseline. So some of the key concepts we can identify, starting from the value function. Central to prospect theory in the S-shaped value function, which illustrates how individuals perceive gains and losses. It demonstrates the losses loom larger than equivalent gains, reflecting the asymmetry in the way people reacted to positive and negative outcomes. This phenomenon, known as loss aversion, it has profound implications for investment behavior, as individuals are more averse to losses then they are inclined towards gains of the same magnitude. Okay. Second is a reference point. The reference point, it serves as a benchmark that against which gains and losses are evaluated. Changes from this reference point, it influences decision making. With the gains and losses, it's related to the reference point, eliciting different emotional responses. For instance, investors, they often exhibit risk-taking and risk-seeking behavior when positioned at a loss related to their reference point, as they seek to recover from the setback. The third is diminishing sensitivity. So, prospect theory, it posits that individuals exhibit diminishing sensitivity to changes in wealth. As the magnitude of gains or losses increases, the incremental impact on a decision making diminishes. This phenomenon that suggests that people are more risk averse for small probabilities. It's involving a large outcomes and a more risk taking and risk seeking for small probabilities involving a small outcomes, we can say now. So final will be on a foundations of a prospect theory we can talk. This is also a very important level. So according to the foundation of a prospect theory, the empirical foundation of a prospect theory that have been established through numerous experiments and real world observations. It's highlighting its robustness in explaining various behavioral anomalies in financial decision making, from the disposition effect, and where investors tend to hold on to losing investments too long and sell the winning investments too soon. So, to the endowment effect, where individuals place a higher value on items they own compared to identifiable items they do not own. So, prospect theory it provides a framework to understand these deviations from rationality. Understand? Okay, the next is implications for investors. Understanding a prospect theory is invaluable for investors seeking to navigate the complexities of financial markets. By recognizing the psychological biases inherent in decision making, investors they can implement strategies to mitigate their impact. For instance, framing investment decisions in terms of gains rather than losses. That process can help alleviate the negative effects of loss aversion. Additionally, diversification and a disciplined portfolio rebalancing, this process can counteract the tendency to hold onto losing investments out of reluctance to realize losses. Understand? So, in conclusion, we can say prospect theory that offers a compelling lens through which to understand the intricacies of a human decision making in financial context. By elucidating the cognitive biases that influence our choices, prospect theory it provides a roadmap for investors and financial professionals to navigate the turbulent waters of uncertainty more effectively. And as we continue to explore the intersection of psychology and economics, prospect theory that stands as a testament to the power of behavioral insights in shaping our understanding of financial behavior. Understand? Okay, the next part that is unveiling the psychology of financial decisions, exploring framing effects under prospect theory. We need to talk here. The complex world of a finance, where numbers reign supreme and rational decision making is presumed to be the norm, there exists a fascinating realm it known as behavioral finance. This interdisciplinary field it integrates insights from psychology and economics to understand how individuals deviate from rationality when making financial decisions. As part of the lecture, we delve into the two intriguing concepts within behavioral finance, that's framing effects and a prospect theory. The first point we need to talk about is framing effects and how presentation affects our decision making. You just imagine you are presented with the two options. The option A, which promises 70% of chances of success, and option B, which presents a 30% of chances of failure. Logically, these options are very equivalent, as 70% of success is the same as 30% of failure. However, studies in behavioral finance that have shown that individuals often make different choices. It's based on how options are framed or presented. So framing effects it refer to the phenomenon where the presentation of information influences decision making. Understand? Even when the underlying content that remains unchanged, whether a situation is framed positively in terms of gains or negatively in terms of losses, this is how the process can significantly alter perception and choices. For example, in investment scenarios, individuals may be more risk averse when options are framed in terms of potential losses. They might opt for safer but lower return investments to avoid the possibility of a loss, even if the expected value is the same as riskier alternatives framed in terms of potential gains. So, understanding of framing effects is a very crucial for investors, as it highlights the importance of very clear communication and transparency in presenting financial information. By recognizing how presentation that can bias the decisions, investors they can strive for objectivity and make a more informed choices that's aligned with their financial goals. The next point we need to talk about the prospect theory and practices, that's application in investment management. We need to talk now. It's developed by psychologists, as I told, Daniel Kahneman and Mostversky in the 1979. Prospect theory that revolutionized the understanding of decision making under uncertainty. Unlike a traditional economic models that assume individuals always make a decisions, it's based on rational calculations of expected utility. That's why the prospect theory it acknowledges that people often deviate from rationality due to cognitive biases and psychological factors. So, at the core of a prospect theory is the concept of a value function and the symmetry of a gains and losses, we can say. And according to the prospect theory, we can say Individuals they tended to weigh potential losses more heavily than equivalent gains. It's leading to risk aversion in the domain of gains and risk seeking behavior in the domain of losses, as I told. So this is asymmetry in risk perception. It influences how individuals make a choices, particularly in uncertain on or risk situations, we can say. So in the realm of investment management, prospect theory, it provides a valuable insights into investor behavior and market dynamics. Investment professionals, they can leverage this understanding to design investment products and strategies that align with investors' preferences and risk attitudes. By framing investments in a way that acknowledges the asymmetry of gains and losses, investment managers they can better cater to investors' psychological tendencies and enhance the decision-making outcomes. So in a final conclusion, we can focus behavioral finance. It offers a nuanced perspective on a financial decision making and revealing the significant impact of a psychological factors on economic behavior. By exploring concepts such as like a framing effects and prospect theory, investors and professionals in finance they can gain a valuable insights into the complexities of human decision making and strive for a better outcomes in the dynamic world of a finance. Okay, my dear students, I hope you have enjoyed the fourth session of the topic of prospect theory. Thank you once again, and thank you all, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the fifth session of the course. The topic name is Market Anomalies. We need to talk in the specific lecture part. So, unraveling the mysteries of a market anomalies, a deep dive into behavioral finance. Actually, in the ever-evolving landscape of finance, understanding the intricacies of a market behavior is a paramount. One fascinating realm within this field is the study of market anomalies, where conventional economic theories that often find themselves at odds with the real-world phenomena. In this part of the lecture, we will embark on a journey through the world of market anomalies, that's exploring their definition, examples, and the insights they offered into human behavior and the financial markets. The first point we need to talk about the what are market anomalies. Market anomalies are deviation from the efficient market hypothesis. The short code is EMH, which posits that asset prices it reflect all available information and therefore should follow a random walk pattern. And these anomalies suggest that markets may not always be rational and efficient as traditional economic theories assume. Okay, some of the examples of a market anomalies we need to talk one by one, starting from the momentum effect. Okay, one prominent market anomaly is the momentum effect, which contradicts the EMH by demonstrating the assets that have performed well in the past tended to continue performing well in the future and vice versa. And this phenomenon challenges the notion of market efficiency as it implies that investors may not fully incorporate all available information into their decision-making process. Second will be a value effect, and another notably anomaly is the valuable effect, which suggests that stocks with a low valuations, example low price to earnings ratios, to tend to outperform stocks with the high valuations over time. So the contradicts the efficient market hypothesis as it implies that investors may systematically undervalue the certain stocks it's based on their perceived risk or future growth potential. The third is the size effect. Actually, the size effect it refers to the observation that a small cap stocks historically have outperformed the largest cap stocks. Despite the higher levels of risk that are associated with the smaller companies, this anomaly it challenges the notion that higher returns are always accompanied by higher levels of risk, as traditional finance theory would suggest here. The fourth is the overreaction and underreaction. So behavioral finance it also highlights the tendencies of investors to overact or underreact to new information. It's leading to price movements that deviate from their intrinsic values now. For example, the dispersion effects it describes investors' tendency to hold on to losing investments too long while selling winning investments too soon. It's leading to suboptimal portfolio performance now. So some of the insights from a market analysis we need to talk. Okay, so studying market anomalies not only sheds light on the limitations of a traditional economic theories, but also it offers valuable insights into the human behavior and the decision-making processes. Actually, behavioral finance, which incorporates psychological principles into financial print analysis, and it provides a framework for understanding these anomalies and their implications for investors. So we can say by recognizing the presence of a market anomalies, Investors they can adopt strategies that exploit these inefficiencies to achieve a superior returns. However, it's very essential to approach anomaly-based strategies with caution as they may be subject to periods of underperformance or market reversals. So in a nutshell, we can say market anomalies it serve as compelling evidence that the financial markets are not always as rational and efficient as traditional economic theories suggest. By delving into these anomalies, we gain a deeper understanding of a human behavior and the complexities of a financial markets. It's empowering us to make a more informed investment decision in an ever-changing landscape, we can say now. Understand? The next point we need to talk about the unraveling the mysteries of behavioral finance, a deep dive into market anomalies. The vast and ever-changing landscape of finance, traditional theories it often clash with observable market phenomena. One such a clash it occurs between the efficient market hypothesis and the existence of a market anomalies. So in this part of the slide, we embark on a journey through the intriguing realm of behavioral finance. It's examining the connection that's between EMH and market anomalies and exploring their implications on investment strategies. The first we need to talk about the exploring the efficient market hypothesis versus market anomalies. The efficient market hypothesis that's proposed by Eugene Fama in the year of 1960s, and he posits that individual markets, that's a financial markets, reflect all available information and asset prices always incorporate this information accurately. So in an efficient market, prices that instantly adjust to new information, it's making it impossible for investors to consistently outperform the market. However, empirical evidence it suggests otherwise, and market anomalies it deviations from the predictions of the EMH it's abound in the financial markets. And these anomalies it challenges the notion of market efficiency and suggests that investors can exploit certain patterns or inefficiencies to achieve a superior returns. So some prominent market anomalies we can talk starting from the momentum effect. As I told, this anomaly contradicts the EMH by demonstrating the assets that have performed well in the past tend to continue performing well in the short to the medium term. And value effect, that's a stock with low price to earning ratios, that is P ratios or other value metrics that process have historically performed, that is outperformed high priced stocks contrary to the EMH prediction of random price movements. We know the concept like a size effect. As I told on a ELA lecture, small cap stocks that have exhibited higher returns over long periods that's compared to the large cap stocks, a phenomenon inconsistent with the EMH. Final, that is a post earnings announcement drift. So stocks it often experience continuous abnormal returns following earnings or announcements, that's contradicting the EMH assumption of immediate price adjustment. Okay, next will be on implications of a market anomalies on investment strategies. We need to talk some other levels. Actually, the presence of a market anomalies that has profound implications for investment strategies and portfolio management. While the EMH it suggests that investors should adopt passive strategies like index investing, acknowledging market anomalies that's open doors to active management approaches. It's aiming to exploit these inefficiencies. The first point, that is a factor-based investing. So investors they can construct portfolios. It's based on a factors such as like company value, stock momentum, stock size, and the profitability. It's leveraging the historical outperformance that's associated with these factors. Second is quantitative strategies. So quantitative investors they utilize sophisticated models and algorithms to identify and capitalize on a market anomaly systematically. And these strategies it often involve extensive data analysis and quantitative research. The third point, that is the behavioral insights. So understanding behavioral biases and psychological factors that's driving a market anomalies. It process can inform a decisions too, and that is investment decisions. So by recognizing patterns of investor behavior, investors they can adjust their strategies to capitalize on mispricings that are caused by cognitive biases. Final point, that is a risk management. So incorporating knowledge of market anomalies into risk management frameworks, this process can help investors mitigate downside risk and enhance the portfolio diversification. By diversifying across the factors that exhibiting a low correlation, investors they can potentially reduce portfolio volatility and improve a risk-adjusted returns. Understand? So in a conclusion, we can say the coexistence of the efficient market hypothesis and the market anomalies it highlights the complexities of financial markets. While the EMH it provides a theoretical framework for understanding the market efficiency, market anomalies that underscore the behavioral and structural inefficiencies that persist in reality. By embracing these anomalies and adopting innovative investment strategies, investors they can navigate the dynamic landscape of finance and strive for enhanced portfolio performance. Okay, my dear students, I hope you have enjoyed this fifth session of the topic of market anomalies. Thank you once again, and thank you all, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the sixth session of the topic. The topic name is Investor Psychology. We need to talk in the specific lecture part. So, unveiling the mind of an investor, understanding risk tolerance and loss aversion. We need to talk in the specific lecture part. In the world of finance, where numbers and data that reign supreme, there is another factor at play that often gets overlooked. So, the human mind. So, behavioral finance it delves into the intricate working of investor psychology, that shedding light on how emotions and biases influence the financial decisions. Among the many facets of this fascinating field, two psychological traits that stand out, that is a risk tolerance and a loss aversion. The first point we need to talk about the understanding of risk tolerance. Risk tolerance is the degree of variability in investment returns that an investor is willing to withstand in pursuit of their investment goals. It's a deeply personal aspect of investing that's shaped by factors such as age, income, financial goals, and most importantly, that is a psychological makeup. So some of the point we need to talk, starting from the factor influencing risk tolerance. That's a age and stage of life we have to concentrate. Younger investors typically have a higher risk tolerance as they have a more time to recover from potential losses. On the other hand, older investors nearing retirement may prefer more conservative investments to protect their capital. Second is the financial situation. So individuals with a stable income and ample savings that may feel more comfortable taking risk with their investments that's compared to those facing financial constraints. And third is experience and knowledge. So seasoned investors who understand the market dynamics and they have experienced various market cycles that may have a higher risk tolerance than novice investors. So second point, that is assessing a risk tolerance. Questionnaires is the first level. Many financial advisors use a risk tolerance questionnaires to gauge an investor's comfort level with risk, and these surveys often inquire about factors such as investment goals, time horizon, and reactions to hypothetical scenarios. Second is a behavioral analysis. According to the process, observing an investor's past behavior during a market fluctuation that can provide insights into their true risk tolerance, as actions often speak louder than words. The third is implications of risk tolerance. Actually, investors with a high risk tolerance, they may allocate a larger position and a portion of their portfolio to volatile assets such as stocks, aiming for high returns over the long term. Conversely, investors with a low risk tolerance may prefer a safer investment such as bonds, mutual funds, or cash equivalents, it prioritizing a capital preservation over potential gains. So some of the grip of loss aversion we need to concentrate. Actually, loss aversion is a psychological bias we know that refers to the tendency of individuals to strongly prefer avoiding losses over acquiring equivalent gains. This phenomenon we can say it's extensively studied by behavioral economists as profound implications for investment decision making. So the first point we have to talk about the psychological impact of losses. Losses larger in the human mind than gains of equal magnitude. Research suggests that the pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. And fear of loss, this process can lead investors to make irrational decisions such as selling investments during market downturns to avoid further losses, even if doing so contradicts their long-term investment strategy. Second process, that is mitigating a loss aversion. According to the diversification, spreading investments across different asset classes, this process can help mitigate the impact of losses in any single investment. So according to the long-term perspective, exactly, focusing on a long-term investment goals and maintaining a disciplined approach, this process can help investors withstand short-term market fluctuations without connecting to the emotional roller coaster of a loss aversion. So third point, that is a behavioral finance strategy. It's a very important part. We need to talk about the framing and education and awareness. According to the framing, so presenting investment options in a way that emphasizes potential gains rather than potential losses, that process can help mitigate the effects of loss aversion. According to the education and awareness, educating investors about the psychological biases that influence decision making, that process can empower them to make a more rational choices in the face of market volatility. Understand? So, in a short conclusion, we can say understanding the psychological traits of investors, particularly risk tolerance and loss aversion, is very essential for navigating the complex landscape of financial markets. By recognizing these psychological biases and employing strategies to mitigate their impact, investors they can make a more informed decisions that's aligned with their long-term financial goals. After all, in the realm of investing, it's not just about the numbers; it's also about mastering the mind. Understand? The next part that is a disappearing investment sentiment. How market sentiment influences decision making. We can talk now. The concept in the dynamic realm of finance, where rationally meets emotion, understanding investor sentiment, that holds the key to unlocking market behavior. So, behavioral finance, a field that blends the psychology with the economics, shed light on how human biases and emotions it influence the financial decisions. Among its intriguing facets, investor sentiment that stands out as a crucial determinant of a market movements and investment outcomes. Okay, some other points we need to talk one by one. The first point that is the psychology behind investor sentiment. At its core, investor sentiment that encapsulates the collective feeling, beliefs, and attitudes of the market participants towards investment opportunities. Exactly, we can say. Unlike a traditional finance theories that assume a rational decision making, behavioral finance that acknowledges the impact of a cognitive biases and emotions on investor behavior. And these sentiments often oscillate between extremes of fear and greed that shaping market trends and asset prices. Second point, we need to talk about the factors influencing investor sentiment. Okay, actually, numerous factors that contribute to shaping investor sentiment. Actually, it's ranging from macroeconomic indicators to geopolitical events and social media trends. So, economic data releases such as like GDP growth figures or unemployment rates, that process can sway investor sentiment by signaling the health of the economy. Similarly, we can say geopolitical tensions, elections, or natural disasters. This all the process can trigger fear or uncertainty among investors. That's leading to market volatility. That's why in the digital age, the influence of social media platforms that cannot be overstated. Like a different type of tweets, Facebook posts, and online discussions. This all the process can swiftly propagate sentiments that's amplifying a market every panic level we can meet. The rise of online investment communities and the democratization of financial information. This all the process have further magnified the impact of retail investors on market sentiment. Understand? Okay, the third point that is a behavioral biases and their effects. Investor sentiment is often susceptible to various cognitive biases, which can cloud judgment and lead to irrational decision making. For instance, a head mentality where investors follow the crowd without conducting due diligence, that process can fuel market bubbles or crashes, as I told. So, confirmation bias, the tendency to seek information that confirms pre-existing beliefs, that process can exacerbate market sentiment by reinforcing collective narratives. We can say now, understand? And loss aversion, that is another prevalent bias. That process can amplify negative sentiment, causing investors to overreact to losses and abandon rational investment strategies. Similarly, recency bias, the tendency to give a more weight to recent events. That process can cause investors to extrapolate short-term trends. It's leading to speculative behavior. The final level, that is implications for investment strategies. Understanding investor sentiment is very paramount for crafting effective investment strategies. So, contrarian investors they often capitalize on a market sentiment extremes, buying when fear pervades the market and selling when greed reaches its peak. So, by adopting a contrarian approach, investors they can exploit a market mispricing it caused by irrational exuberance or unwarranted pessimism. We can say. Moreover, we can say integrating sentiment analysis into investment decision making processes, it can enhance the risk management and asset allocation. By gauging a market sentiment indicator such as the CBOE Volatility Index, that is VIX, or surveys of investor sentiment, investors they can anticipate market reversals and adjust their portfolios accordingly. So, in a conclusion, we can say The intricate tapestry of a financial markets, investor sentiment, it emerges as a powerful force that shapes the market dynamics and investment outcomes. By delving into the psychology of a market participants, understanding the myriad of factors influencing sentiment, investors they can gain a valuable insights into the market trends and navigate turbulent waters with a greater resilience. So, while sentiment-driven fluctuations, it may test the investor resolve those armed with advanced understanding of a behavioral finance. Is all the process can harness sentiment as a guiding compass in their quest for financial success. Understand? So the next is we need to talk about the another level. So the next part we need to talk about the decoding investor behavior. That's navigating bull and bear markets. We have to talk now. So, in this installment of the lecture part, we delve into the fascinating realm of investor behavior within the dynamic landscape of bull and bear markets. While traditional finance theories, it often assumes rational decision making by investors, behavioral finance that sheds light on the psychological biases and emotional responses that influence the market participants, particularly during a periods of market connections and downturns. Okay, let's embark on this journey to understand how investors react and behave that differently in a bull and bear markets. The first is bull market mania, like a greed, euphoria, and FOMO. It's because the bull markets are characterized by optimism, its rising asset prices, and a pervasive sense of euphoria among investors. So during these periods, behavioral biases such as like overconfidence and herd mentality tended to dominate the decision-making processes. Second would be an overconfidence. So investors may become excessively confident in their ability to pick up winning stocks or time the market. It's leading to increased trading activity and a higher risk-taking behavior. Third level, that is a herd mentality, the fear of missing out, that is FOMO. It drives investors to follow the crowd. It's leading to herd behavior and asset bubbles. As prices soar, investors they often ignore fundamental valuations and join the buying frenzy. Finally, maybe a confirmation bias. So investors they seek out information that validates their bullish views, disregarding contrary evidence or warning signs of an impending market corrections too. So actually understanding these biases, it can help investors recognize when irrational connection is driving a market sentiment and take steps to avoid speculative bubbles. Second point, that is a bear market blues. So fear, panic, and cognitive biases. Bear markets characterized by failing prices and widespread pessimism. It's evoke a fear and uncertainty among investors. So behavioral biases it play a significant role in exacerbating market downturns and prolonging periods of a negative sentiment. Understand? So what are the points we need to talk? Starting from the loss aversion. Actually, investors experience greater emotional pain from losses than pleasure from equivalent gains. It's leading to panicked selling during a market downturns. This behavior intensifies as losses accumulate, that's contributing to downward spirals in asset prices. Second is a recency bias. As I told, investors they tend to extrapolate recent market trends into the future, assuming that the current downtrend will persist indefinitely. And this myopic focus on short-term performance can lead to selling at the bottom of the market. The third is anchoring. So investors anchor their perception of fair value to previous market highs. It causing them to resist accepting lower prices and delaying the reinvestment decisions until prices rebound to unrealistic levels. So recognizing these cognitive biases, it can help investors adopt a more disciplined and rational approach to navigating a bear markets. It's focusing on long-term investment objectives rather than a short-term market fluctuations too. So in a final conclusion, we can say understanding investor behavior in a bull and a bear markets is essential for navigating the complexities of financial markets. By recognizing the psychological biases and emotional triggers that influence decision making, so investors they can make a more informed and disciplined choices and mitigating the impact of a market volatility on their portfolios too. So behavioral finance it offers a valuable insights into the intricacies of human behavior in the realm of finance. It's reminding us that market movements are not solely driven by economic fundamentals, but also by the collective emotions and biases of market participants too. Okay, my dear students, I hope you have enjoyed another session of the topic of investor psychology. Thank you once again, and thank you all, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the another session. The topic name is Behavioral Finance and Investment Strategies. We need to talk in the specific lecture module. So, enhancing investment strategies, that is integrating a behavioral finance into decision making, we need to talk in the specific module. Actually, in the ever-evolving landscape of finance, traditional economic theories it's often struggle to fully explain the complexities of investor behavior and market dynamics. So we need to enter behavioral finance, a field that combines insights from psychology with the financial theory to understand why investors make irrational decisions and how these decisions impact markets. So actually, one area where behavioral finance that it truly science is in investment decision making, by acknowledging and understanding the cognitive biases and emotional influences that drive investor behavior. So financial professionals they can craft more effective investment strategy. Okay, so let's delve into the how integrated behavioral finance principles that process can enhance the investment decision making. The first point we need to talk about the understanding investor behavior. Actually, traditional finance theory it assumes that investors are rational beings who make a decisions it's based on all available information to maximize utility. However, behavioral finance it recognizes that human beings are not always rational. So emotions, cognitive biases, and heuristics it often lead investors to make a decisions that deviate from rationality. For instance, investors they may exhibit overconfidence, anchoring, and loss aversion or head behavior. It's among other biases, and these biases can lead to suboptimal investment decisions such as buying high and selling low or holding on to losing investments for too long. Already we have discussed a lot of information on the previous lectures. So the next concept integrating behavioral finance into investment strategy starting from the recognizing biases. The first step in integrating behavioral finance into investment decision making it is recognizing the various biases that can influence investor behavior. So financial professionals they must be aware of these biases and their potential impact on investment decisions. Second is a behavioral analysis. So conducting behavioral analysis it involves examining how psychological factors influence the market trends and investor behavior. By understanding the underlying drivers of market movements, investors they can make a more informed decisions. Okay. The third is applying heuristics. As I told, heuristics or mental shortcuts. It's often aid investors astray. Identifying a common heuristics that used by investors such as the availability heuristic or representativeness heuristics. So financial professionals they can develop strategies to counteract their effects as I told. The fourth is emotional management. So emotions it play a significant role in investment decisions. Actually, financial professionals they must help investors manage their emotions by implementing strategies such as setting a clear investment goals, maintaining a long-term perspective, and avoiding impulsive decision-making process. So the next will be on creating a decision frameworks, developing decision frameworks that account for behavioral biases. This process can help investors make a more rational choices, and these frameworks may include pre-commitment strategies, diversification techniques, and risk management protocols. So, what are the benefits of a behavioral finance integration? Actually, integrating behavioral finance into investment decision making offers several benefits, starting from the improved decision making is the first benefit by understanding the psychological factors that drive investor behavior. So, financial professionals they can make a more informed and rational investment decisions. Second is enhanced risk management. So, behavioral finance it helps identify and mitigate risk that are associated with irrational investor behavior. It's reducing the likelihood of significant losses. The third point that is increased client certification. So clients appreciate the financial advisors who consider their behavioral tendencies and emotions when crafting investment strategies. By addressing these factors, advisors they can build a stronger client relationships and improve satisfaction. So, in conclusion, we can say incorporating behavioral finance it, and principles into investment decision making, it is very essential for navigating today's complex financial markets. By recognizing biases, conducting behavioral analysis, and applying strategies to counteract irrational behavior, financial professionals they can develop a more effective investment strategies and ultimately achieve a better outcomes for their clients. So embracing the insights of behavioral finance is not just a trend, it's a crucial step toward optimizing investment decision making in an increasingly dynamic and unpredictable world. Understand? The next part of the slide, we need to talk about the navigating investment psychology. The behavioral portfolio theory. We need to talk now. So, in this part of the slide, we will delve into the fascinating realm of where human psychology that intersects with the portfolio construction. Like a behavioral portfolio theory, the shortcut is BPT. Unlike a traditional finance theories that assume a rational decision making, so behavioral portfolio theory, it acknowledges the influence of a cognitive biases, emotions, and heuristics on investor choices. Okay, just to join us, we need to explore some of the how understanding these behavioral aspects can revolutionize the portfolio management. The first concept we need to talk about the understanding of behavioral portfolio theory. Behavioral portfolio theory proposed by Sheffrin and Statman in the 1994 challenges to the conventional wisdom of a modern portfolio theory. While a modern portfolio theory, it emphasizes diversification and risk return optimization, and BPT, that is, BPT, it incorporates investor psychological traits into the investment process, and it recognizes the investors. It often deviate from rationality due to cognitive limitations and emotional biases. So the next level, constructing a portfolio through a behavioral lens, we need to talk up to the importance of a five levels. The first is investor preferences and biases. BPT, that is behavioral portfolio theory, it begins with a deep understanding of investor preferences and biases. So investors' risk tolerance, time horizons, loss aversion, and overconfidence, it significantly influence their portfolio decisions. So by acknowledging these biases, portfolio managers they can tailor investment strategies that align with investor psychological profiles. Second point, that is a heuristic based asset location. BPT, it suggests that investors rely on heuristics or mental shortcuts to simplify the complex decision making. And portfolio construction under BPT, it involves designing investment strategies that accommodate these heuristics. For instance, we can say investors, they often exhibit a preference of familiar assets or recent winners, that's availability bias. So portfolio managers, they can leverage this insight by incorporating assets with the familiar characteristics or recent outperformance into the portfolio. The third point, that is a behavioral asset pricing. It's also very important level, my dear students. Traditional finance, it assumes that asset prices reflect all available information and follow a random walk. However, behavioral finance, it argues that the investor sentiment and psychological biases can lead to market inefficiency and mispricing. So portfolio managers, they employing a BPT consider these behavioral anomalies when valuing assets and making investment decisions too. The fourth point, that is a risk management and a loss aversion. BPT recognizes the investors are most sensitive to losses that gains, that is loss aversion. Consequently, portfolio managers, they adopt risk management techniques that mitigate the impact of losses on investor psychology. Strategies such as dynamic asset location, downside risk protection, and incorporating alternative investments process is all the process can help alleviate investors' fear of losses and enhance the portfolio resilience. We can focus more. Fifth and final point, that is adaptive portfolio strategies. So behavioral portfolio theory, it emphasizes the importance of adaptive portfolio strategies that evolve with the changing market conditions and investor sentiment. So portfolio managers continuously monitor investor behavior, market trends, and psychological indicators to adjust the portfolio allocations accordingly. This dynamic approach, this dynamic approach is a very important level, and that the portfolio remains aligned with investors' changing risk appetites and market expectations too. So in a nutshell, we can say incorporating behavioral insights into the portfolio construction, it can lead to more robust investment strategies that account for the complexities of human psychology. So behavioral portfolio theory, it offers a paradigm shift from the traditional rational models of finance, acknowledging the inherent biases and emotions that influence investors' decision making. By constructing portfolio through a behavioral lens, investors and portfolio managers, they can navigate market volatility more effectively and achieve their long-term financial objectives. Okay, the next part, we need to talk about the mastering market inefficiencies. Behavioral trading strategies, we need to talk in the specific level lecture. In the world of finance, we can say markets are often viewed as rational entities where participants make a decisions. It's based on a careful analysis of all available information. However, the reality is far more complex. Okay, so human behavior, it plays a significant role in shaping market dynamics. it often leading to inefficiencies that can be exploited by astute traders. The intersection of psychology and finance is the essence of behavioral trading strategies. Okay, the first we need to talk about understanding behavioral finance. As I told on a year level, behavioral finance challenges under traditional economic theory that assumes investors are rational and always act in their best interest. Instead, it acknowledges that investors are subject to cognitive biases, emotional influences, and heuristics that can lead to irrational decision making. And these biases manifest in various forms such as like overconfidence, loss aversion, hedging behavior, and anchoring, among others. So, what are the behavioral training strategies? Okay, starting from the contrarian investing. Contrarian investors they go against the crowd, capitalizing on a market overreactions to news or events. They buy when sentiment is overly pessimistic and sell when it excessively optimistic. So the strategy exploits the tendency of investors to overreact to short-term developments. It's creating a mispricings in the market. Second is a momentum trading. So momentum traders they ride the wave of market trends, buying assets that have shown upward momentum and selling short those on a downward trend. The strategy exploits the behavioral bias of a trend following, where investors extrapolate recent performance into the future, it causing movement to persist beyond rational levels. The third is a mean reversion. Mean reversion traders exploit the tendency of a market to oscillate around their long-term averages. When prices deviate significantly from their historical means, these traders anticipate a return to the mean and position themselves accordingly. This strategy capitalizes on the psychological phenomenon of regression to the mean, where extreme events are followed by a period of normalization. The fourth is arbitrage opportunities. So arbitrage it involves exploiting price discrepancies between related assets or markets to generate the risk-free profits. So behavioral biases that process can lead to temporary mispricing. It's allowing astute traders to arbitrage away the inefficiencies. And examples include like merger arbitrage, where mispricing occurs due to investor overreactions to acquisition announcements, and statistical arbitrage, which exploits short-term deviations from historical relationships between assets. Okay. Fifth and final, that is a sentiment analysis. Sentiment analysis it involves gauging market sentiment through various indicators such as like news, sentiment, social media activity, and investor surveys. By understanding the prevailing sentiment, traders they can anticipate market movements driven by irrational connection or pessimism. The strategy leverages the behavioral bias of herding, where investors tend to follow the crowd without critical analysis mode. So in a final conclusion, we can focus behavioral trading strategies. It will provide a powerful toolkit for traders the seeking to capitalize on a market inefficiencies. It's driven by human psychology. By acknowledging the prevalence of cognitive biases and emotional influences in decision making, traders they can develop nuanced approaches to exploit these tendencies for a profit level, whether through contrarian investing, momentum trading, mean reversion, arbitrage opportunities, or sentiment analysis. The principles of behavioral finance it offer valuable insights into the market dynamics. However, it's a very crucial to approach behavioral trading with caution and discipline. While these strategies can yield a significant returns, and they also entail risk too, particularly in volatile markets where irrational behavior may exacerbate price swings. And a successful implementation it requires a thorough research and robust risk management and a keen awareness of one's own biases. Ultimately, we can say mastering behavioral trading strategies it requires a blend of analytical skills and a psychological insight. By integrating these approaches into their trading arsenal, investors they can navigate the complexities of financial markets with a greater confidence and effectiveness. That's potentially unlocking the new avenues for success in an ever-evolving financial landscape. Okay, my dear students, I hope you have enjoyed the another session of the topic of behavioral finance and investment strategies we have discussed in this specific lecture mode. Thank you once again, and thank you all, my dear students. Good morning, my dear students. Good morning, one and all. Welcome to the eighth and final session of the course. The topic name is Behavioral Finance and Practice. We need to talk in this specific lecture module. So, navigating the human element, what are the practical insights into the behavioral finance? The realm of finance, understanding the intricacies of human behavior is just as crucial as comprehending market trends and economic indicators. Behavioral finance, it delves into the psychology behind financial decisions, that is shedding light on why investors often deviate from rationality and how these deviations impact the markets. So in this part of the lecture, we explore the practical applications of behavioral finance, that are drawing insights from real-world case studies and are discussing ethical considerations and its implementation also we need to talk now. Starting from the behavioral finance case studies, so real-world examples and the lessons learned to truly grasp the power of behavioral finance, and one must turn to real-life scenarios where human emotions and biases that influence financial decisions. So we need to consider the case of the dot-com bubble of the late 1990s, where investors flocked to technology stocks driven by the fear of missing out rather than sound investment principles. This frenzy led to inflated valuations and ultimately a market crash. And another notable example is the housing market that's collapse of 2008. It's fueled by overconfidence and herd mentality among home buyers and investors alike. So many connections to the belief that housing prices would continue to soar indefinitely, that's ignoring a warning signs and engaging in a risky lending prices too and practices too. So these all the case studies underscore the importance of recognizing behavioral biases such as like overconfidence, head mentality, and loss aversion. By understanding these patterns, investors and financial professionals they can better navigate the turbulent market conditions and make a more informed decisions too. Second will be in a practical applications of a behavioral finance and financial advisory. Financial advisors they play a pivotal role in helping clients they navigate the complexities of investing, retirement planning, and wealth management by by incorporating insights from a behavioral finance. Advisors they can tailor their recommendations to align with the client's goals and risk tolerances while also addressing their behavioral biases. And one practical applications to behavioral finances and financial advisory is the use of personalized goal-based planning. Rather than focusing solely on investment returns, advisors work with the clients to identify their unique financial goals, whether it's buying a home, funding education, or returning comfortably. By framing investment strategies within the context of these goals, advisors they can help clients stay disciplined and focused on the long run. Moreover, we can say behavioral finance principles that process can inform our communication strategies that's helping advisors manage a client expectations during a periods of a market volatility. By providing reassurance and framing market downturns as opportunities rather than threats, advisors they can help our clients avoid a panic-driven decisions that may harm their long-term financial prospects instead. The third and final point that is ethical considerations in applying behavioral finance principles. While behavioral finance it offers a valuable insights into human behavior, its applications it raises important ethical considerations. Financial professionals they have a duty to act in the best interest of their clients, which may sometimes conflict with exploiting behavioral biases for financial gain. And one ethical dilemma it revolves around the use of nudges or behavioral interventions to influence client behavior. While nudges can help steer clients towards better financial choices, there is a fine line between nudging and manipulation, we can say. So financial professionals they must exercise caution and transparency when employing behavioral techniques. It's ensuring that the clients are fully informed and empowered to make their own decisions there. And another ethical concern is the potential for exploitation of vulnerable populations such as the elderly or financially illiterate. So advisors must prioritize client welfare and refrain from taking advantage of cognitive biases for personal gain. So in a nutshell, we can say behavioral finance it offers invaluable insights into the complex interplay that's between a human psychology and financial decision making. By studying real-world case studies, implementing practical applications in financial advisory, and considering ethical implications, professionals they can harness the power of behavioral finance to better serve their clients and promote a financial well-being. So as we navigate an ever-changing financial landscape, understanding the human element, it remains a paramount in achieving a long-term success, my dear students. Okay, my dear students, I hope you have enjoyed the final session of the topic of behavioral finance in practice. Thank you once again and thank you all, my dear students.